Hello and welcome to this week's Money Roundup.
One of the biggest stories this past week has been the Bank of England's decision to raise the UK interest rates from 0.5% to 0.75%. This has been the highest rate since way back in 2009.
The Bank of England explained their decision with three key factors. Inflation is currently above its 2% target, the squeeze on pay is easing, and economic growth is probably growing about as fast as it can without overheating.
Low and stable inflation is vital for an economy that supports growth and jobs. And now that the economy is strengthening, there are going to be occasional gradual interest rates rises to ensure that the economy doesn't overheat and suffer from high inflation.
Interest rates are linked to things such as mortgages and some savings accounts. You'll probably notice the change in interest rates most if you're a variable or tracker mortgage holder, with your payments increasing. On the plus side, some savings accounts may pay more interest.
The decision by the Bank of England to put up interest rates for the first time in 9 years represents a step towards policy normality. It is indicative of the bank taking steps in order to avoid upsets along the rate rising journey. Yes, higher interest rates will mean higher borrowing costs for some, but the context for this happening is favourable. It is indicative of more confidence in the growth outlook.
The Federal Open Market Committee gave an incredibly bullish assessment on the US economy during their meeting last Wednesday. With its minutes reporting, the labour market has continued to strengthen and economic activity has been rising at a strong rate.
Economic growth, as measured by GDP percentage, has jumped from 2.2% in quarter 2 to 4.1%, breaking through the 3% target.
This reflects growing business confidence for the future and gratitude for Trump's tax cut. Consumers have also played an important role by increasing spending.
The Federal Open Market Committee will reconvene for 2 days on September 25th to vote on interest rates, and analysts are suggesting that there is a 90% chance a hike will occur, taking rates to a range of 2% to 2.25%.
One business that has reflected the current US economic strength is Apple. Their stock price went above $200 this past week, giving the tech giant a worth of $1 trillion.
Apple has become the world's first public company to be worth $1 trillion, and its stock has risen more than 50,000% since first listed in 1980.
Developed economies around the world have been on a lengthy recovery since the financial crisis 10 years ago. The US Federal Reserve Bank, the Bank of England, and the European Central Bank have now all started to reverse their loose monetary policies. Japan is the exception. With a rapidly aging society, poor demographic trends have kept the Bank of Japan in check.
The Bank of Japan confirmed this past week that there will be no adjustments to its quantitative easing program. And for the first time, they provided forward guidance stating that current interest rates would continue for an extended period of time, crushing thoughts of a move towards higher rates. Thanks for watching. Subscribe to the True Potential Investor YouTube channel, where this week you'll see the latest episode of our Meet the Investment Team series.